You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well today. All right, so the other day, I'm at the grocery store, and Caleb, my youngest son, says, wow, Yuzu Sushi, they're really everywhere. They might be making so much money because he's a big fan of sushi. We have Yuzu Sushis pretty much everywhere, and they are also selling at IGA. And kind of funny because I asked him, did you know that your sister is actually working at the same company who owns Yuzu? And then he stares back at me and he's like, well, that doesn't make sense, Dad, because she's working at Mike's, and Mike's are selling pizza and submarines. What's the link between pizza and sushi, right? Well, it is called MTY Foods. I thought of doing this review. They had a pretty bad moment during COVID, but since then they suspended their dividend back then, and then they started back paying a dividend, increasing it double digit for a while now. So maybe it's deserve a look to see if it's a good fit in your portfolio. So to get started with the investment thesis. So for the investment thesis, we're going to start with the playbook. So the playbook for MTY Foods is quite simple. They are all about making franchise for restaurants. So they have bunch of brands. They have 7,000 restaurants, and across brands, you'll have Thai Zone. Not Thai Zone, but Thai Express. See how it could get confusing. They have sushi shops. They have Mike's. They have Baton Rouge. They have Mr. Sub, Yuzu Sushi, Pizza Delight. They do Scores. They have so many different brands. Then the whole goal here is to generate those royalties, right? 96% of their restaurants are franchise. So basically, they're just getting those royalties. So low CapEx, they don't have to spend much money. That creates a lot of cash flow and, of course, a lot of flexibility. So that's their playbook. In terms of growth vectors, how do they grow each year, right? So of course you have organic growth and growth by acquisition. So they are always looking to buy new brands, but the other thing that will drive a lot of their growth is of course opening new restaurants across all those brands. Then they can go a little bit more focus on menu innovation, marketing, pricing strategies. We're going to get there in the risk section, but it's really tough environment. They are competing against a lot of other restaurant and other brands. So they need to invest massively into marketing to make it work. In terms of economic mode, so what protects their business model? Well, I'd say maybe brand a bit. You all have your favorite pizza restaurant or burger restaurant and so on. So maybe the brand will protect a little bit of your business. The fact that they can scale though, because they operate a lot of different franchises and they have a wide network of restaurant is another way they could kind of protect by economies of scales. But as you can see, they're not that obvious. It's not that strong. It could be better. There's not much. I just said in the introduction, I said Thai Zone, but it's actually Thai Express. So there's not much difference. If I feel like having Thai food, kind of like the fast food types, I could go to Thai Zone, I could go to Thai Express. I might not see much of a difference as a consumer depending on the taste. So just want to highlight that. So what does it look now in terms of numbers? Because it's interesting to have the narrative, but now you have to know what's really going on. So revenue over the past 5 years, double digit. We're talking about 16% annualized growth rate. So very, very strong. Again, combination of organic and growth by acquisition. The earnings per share is getting very weak in the, if you look at the graph, we do have it like a dividend stocks rock. So it's kind of like stable between 2022 to 2024. But then over the past few quarters, it's going down very fast. So that is a problem. The other problem I see also, I forget to mention for the revenue, is the revenue grew very fast between 2021 and 2024. But since then, over the past like few quarters, it's quite stable, so not as impressive. And for the earnings, I'm just going to put a pin on that, and I'm going to come back later on today. It's super important to figure out what's going on, because you see that revenue are stagnating, and then the earnings per share is like going down very fast. Latest quarters were actually negative. They reported a loss. You need to understand why. That's a real signal of investigation. In terms of dividend, well, it's growing double digit as well. So you see that there's something interesting here. So you have revenue and dividend growing double digit, but earnings are free falling. So now you're just like, yikes, there is a problem. So how can you solve that problem? Well, you must go into the quarterly earnings. There's like no other ways. You need to dig a little bit deeper to understand what's going on. So on one side, earnings are getting hurt in general because of inflation. So cost of food, cost of labor, increase in leases, all of that are putting pressures on franchisees. So it's a little bit harder also for MTY Foods, the parent company. The other thing, though, is there is a major loss that was reported, mostly that the good news is it's a non-cash event. The bad news is they have to charge a lot of impairments and reduce the goodwill, mostly on Papa Murphy's brand, because it's not performing expected. So long story short, they made the acquisition, they add a lot of value in goodwill, so the brand name, what it's worth on their balance sheet, and then when it's not good enough, they have to write off a part of that and say, yeah, that's not exactly worth that much. It's worth a lot less. In this case, they took 64.6 million off of goodwill for Murphy's. That's a lot of money for a company that has a market capitalization just shy of $1 billion. So we're roughly like at $900 million. So you're taking off $65 million out of like value. Of course, it hurts earnings, but it has a major impact. And that's what was the problem was. So instead of looking at companies with like shaky dividend triangle like this one, if you're looking for strong ones, I highly suggest that you download our Rockstar list. The Rockstar list is found at moosemarkets.com/rockstars with an S, where I put all the companies showing revenue growth, dividend growth, and earnings per share growth consistently over the past 5 years. So it's a great start to look for your new buys. Again, moosemarkets.com/rockstars. Now let's wrap it up with the risks, because of course, yeah, it's a great business model, low on capex, generate a lot of cash flow, great dividend increases, but there are some risks that comes with MTY Food. The first one, when we look, is the business flaws. Well, the company operates a lot of brands. It could be complex. They can have like failed concepts, like similar to what we just saw with Papa Murphy's, not performing as expected. And when this happens, it creates even more confusion for the brand, for the consumer, and it could end up into big losses. By the business model, they're also affected by higher leases, inflation pressure. And one thing that you have to understand is, even though a lot of the costs are being taken care by the franchisees, well, if the franchisees are having a tough time, they're not going to pay that much in royalties to the franchisors, or they will have to close restaurants, which of course doesn't generate any royalties anymore. So while you are putting a lot of pressure, capital pressure on the franchisees, in the end, it's still the business. And if the restaurants are not doing that great, well, everybody is not making that much money. That includes MTY Food. Finally, in terms of the business flaw, well, be careful of small caps. A company with $900 million in market capitalization is a small company. It could go down very fast. It could go up very fast too, but be ready for a roller coaster ride in terms of stock price. In terms of the industry and market trend, well, they're operating in a discretionary industry. Consumers, if they're tight with their budget, they're not going to go to the restaurant. That's pretty much straightforward. The economy is the big driver here, actually, in terms of like growth vectors or decline vectors. US exposure could increase also currency. So there's a lot there related to the economy. Finally, in terms of competitors, I mean, you have the choice, right? You have like restaurant brands, you have McDonald's, you have A&W, you have Yums, you have Domino's, you have like so many other options. And the thing is, as a consumer, you're not going to eat at a restaurant every single day of your life. I mean, if you do, well, you'll have to hit the gym a lot of times as well. So a lot of competition, a lot of things that is like very hard in terms of like differentiation as well. So not that easy. The biggest concern and the reason why the stock price is going down right now, in my opinion, is probably the concern around the ability of the company to grow the business while maintaining a high level of profit, considering that lease costs are increasing, labor costs is increasing. Discretionary restaurant services like this, quite volatile. So it's hard to have like a very steady business model. And this is probably why MTY has a tough time. I mean, as long as it grows, it's going to bring up the hype, but it's not the case right now. So hence the stock price is having a hard time since 2023. So Moose, I hope that you have enjoyed this one. If you're looking for better stocks or stocks with strong metrics, start your research at moosemarkets.com/rockstars to download your list. And we're going to talk again on Wednesday. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.